So I've tried to explain the impact of taxation reforms in two sort of concise videos, and then we'll look at welfare reforms. So basically, when we're looking at taxation reforms, we're looking at changes in the way the government collects tax. So that can include changes in the income and company taxes. It can also include reviewing the tax base, so putting tax on certain things and removing tax from other things, like increasing GST and removing income or company taxes, and basically improving the tax mix, so we're taxing the right combination of goods and services. The aim of tax reforms is to increase incentives for businesses to invest and produce and encourage individuals to work harder. So we're trying to increase our international competitiveness, increase productivity, increase participation, and improve our overall aggregate supply. So essentially, some reasons why we need to reform our tax system. Basically, we want to replace inefficient taxes with more efficient ones. So getting rid of things like reducing income and company taxes, which have negative impacts on investment and productivity and participation, and replacing them with things like excise taxes, which are better for allocative efficiency. Our ageing population means we need to change our tax base because we have not enough revenue coming in. And we also need to make sure that our tax base doesn't discourage participation, because with our ageing population, participation is going to be an issue. So we need to make sure our tax base is not discouraging that. Our tax burden, particularly our company tax rates, can hurt international competitiveness and discourage foreign investment. So one reason we want tax reforms is to encourage foreign investment. And the last one I'd focus on is that we need to make sure we're lowering income taxes consistently to try and avoid bracket creep, where people are being pushed into higher tax brackets. So essentially, tax reforms can include changes to direct taxes, which are more broad, so changes to income and company taxes, or they can be more specific to businesses, like changes to tax concessions for research and development or rebates for certain parts of activity. It can also include changing it so we have more indirect taxes as well. So in terms of the main taxes, it's really important you're aware of the main tax reforms in recent budgets. So these ones here is a summary of the key things they've done this year. So the first one's related to tax relief. They're going to provide up to a $1,080 rebate for singles and $160 for couples. Basically, if you earn up to $126,000, you can get access to some of these benefits, with the main benefits stemming for those earning between $47,000 and $90,000. And secondly, in 24-25, so in 5 years, they're going to remove the 32.5% and the 37% tax bracket and just have one 30% tax bracket, which will encourage more participation and lower effective tax rates for workers. The instant write-off has been extended, so now you can claim assets up to $30,000 if your turnover is less than $50 million, and that's gone up from $25,000. The third one is the company tax rate is going to be cut to 25% for all businesses from the year 2021-22. That's part of what this thing called the 10-year tax plan, which has been consistently lowering company tax rates. So currently they're down to 27.5%, but it's been passed that they'll go down to 25% by 21-22. And lastly, the last reform is the 150% tax concessions for businesses investing in research and development. So companies earning less than $20 million can invest in research and development, and they get 150% tax concessions on all expenditure, which inflates their expenditure and reduces their profits. So be mindful that tax cuts are generally more permanent, whereas tax concessions are generally more specific, and they may last for a shorter period of time. Tax cuts are generally more broad than tax concessions. So in terms of the impacts, I just want to quickly go through the sort of things you can talk about when you're linking these to the goals. So if we're starting with lower income taxes, yes, they have an impact on demand. So if you're talking about as a demand management policy, you'd be focusing on the impact on disposable income and growth through increased consumption, therefore more production. But we're focusing on supply here. So what you want to be talking about is it helps to boost supply because workers are generally willing to work longer hours because they get to keep more of their income. It encourages workers to increase their efforts and increase their performance. Other individuals have a greater incentive to boost their skills because they're going to get to keep more of their money from any further income, and may invest more in education and training, which has benefits for productivity. Lower income taxes can boost participation rates because those not in the workforce may be incentivized to come back because they know they're going to get to keep more of their money. Lower tax rates can lead to increases in immigration as well. So there's heaps of links to supply you can make. There's increases in people working harder, people working longer hours, people joining the workforce, but also people from other countries. We attract the best talent or the best skills from overseas because there's a greater incentive to work in Australia. So the increase in immigration can also boost participation and have somewhat similar benefits to some of the other things we were talking about. Lower income taxes place downward pressure on labour because it leads to an increase in labour supply. So there's lower labour costs associated with lower income taxes. So along with the increase in productivity, participation can be linked to lower labour costs. Oops. Lower real unit labour costs help to put downward pressure on production costs and increase businesses' willingness to supply. They also provide a greater incentive for unincorporated businesses, so small businesses, to invest because they know that any future profits will be taxed at a lower rate as well. So you can also link it to business investment. So all these things can be linked to supply. Working longer hours, working harder, more people participating, increased competition, lower wage pressures, increased immigration, and increased investment for unincorporated businesses. All benefits for supply and growth of income tax cuts. In terms of company tax cuts, as I said, it's gone down to 25% for all businesses earning less than $50 million. Unincorporated businesses will also get an income tax cut, which will increase their investment spending as well. When you're linking this to growth, there's a range of things you can talk about. You can link it to foreign investment for starters. So more foreign firms want to establish themselves in Australia. That creates more jobs, more production as well, and we get access to new ideas and new skills, but also encourages local firms to invest in a range of assets like plant and machinery and equipment. This will boost demand in the short term, but then once we've invested in these things, it boosts our productive capacity because we've got access to this new machinery, this new equipment. That all lowers firms' cost of production as a starting point, and therefore makes them more willing and able to supply. So a 1% company tax cut generally leads to approximately a 0.2% increase in real GDP in the long run. Okay, so the next, tax concessions. So tax concessions work similar to rebates, where basically you pay less tax because of investment, which effectively saves you money, just like getting cash in the first place. It helps to reduce their tax liability by inflating their tax deductions. So you need to be able to explain tax concessions really clearly. They allow firms to inflate their expenditure and therefore reduce their encourage and reduce their taxable income, and therefore it provides that incentive to invest in these products. Tax concessions allow the government to focus on particular areas of investment. They encourage businesses' investment in innovative products, new ways of doing things, new ideas. It's really important you focus on that in detail when you're talking about tax concessions, which help to boost our international competitiveness and productivity. So they also aim to export to help, also provide assistance to help us to export to larger markets so we can get access to a greater market share. And then accelerated depreciation allowances allow firms to reduce their effective tax liability by immediately writing off assets up to $30,000. That encourages asset purchases and allows them anything under $30,000 to reduce their profits and reduce their effective tax liability. It encourages investment in new capital, the latest technology, the best ways of doing things, which boosts efficiency and productivity, which boosts our productive capacity. In terms of the goals, tax reforms and the goals, changes to taxes have a powerful impact on a range of things, whether it's personal effort, productivity, greater effort, investment, and entrepreneurship. They also prevent bracket creep, but in the long term, the aim of tax concessions is to reduce the burden of direct taxes, which will help to increase productivity, increase our willingness to supply. Okay, we consistently want to use the word willingness to supply, and boost real GDP and national incomes. Accelerated depreciation and company taxes also promote investment, which boosts the quality of our capital resources, which boosts productivity and efficiency. All this stuff lowers firms' cost of production, makes them more willing to supply. So in terms of low inflation, thinking of tax cuts can help reduce cost-push inflation. So lower income taxes do increase disposable incomes, can make workers less likely to fight for higher wages, but also provides greater incentive to boost education, to gain new skills, which all boost labour productivity. Lower company tax rates allow them to have higher tax profits, which allows them to set lower prices because they've got lower production costs. It also encourages investment in new technology, which boosts technical efficiency. Lower tariffs, which we haven't really talked about, encourage specialisation, which boosts efficiency because we shift resources to areas where we're more allocatively efficient, where we have cost of production, where we have comparative advantage. In terms of strong and sustainable growth, you can link it to the incentive to work hard, increase labour force participation, which helps to boost the quantity of labour resources. Cutting income taxes helps to promote foreign and domestic investment, which boosts efficiency and our overall willingness to supply as well. In terms of full employment, lower marginal tax rates boost the incentive to work and to get a job, so it should reduce voluntary unemployment or hardcore unemployment. The boost in productivity and lower business costs also encourage businesses to expand because they're more profitable. It also encourages more international competitiveness because of the lower prices, which all creates jobs as well. Lower company tax rates encourage after-tax profits, reducing business closures, encouraging investment, which all creates jobs as well. In terms of living standards, promoting lower cost inflation helps to lower prices and boost purchasing power. Tax reforms that boost efficiency have to offset some of the negatives from a lower participation rate, so that increase in participation can increase tax revenue. Lower unemployment helps to reduce crime levels and stress levels. Tax reforms that incorrectly price the environmental cost of transit. That's a bit too specific. Okay, so here's just one question to finish this video. Explain why a less progressive tax system might be associated with an increase in the efficiency of resource allocation. So to explain what a progressive tax system is, when the marginal tax rates imposed on income earners increases in line with incomes. So those earning less than $18,200, for example, pay 0. Then those earning more than $180,000 pay 45%. So explain what a marginal tax bracket is. A less progressive income tax system would mean that the marginal tax rates do not climb as steeply. So explain what that is. So a higher income earner doesn't get taxed as higher rate. In terms of boosting productivity, they argue that lower marginal tax rates provide the incentives for workers to increase their efforts in the workplace, especially if their wages are linked to productivity. So basically, they get to keep more of their income rather than losing it to the government. So therefore, technical efficiency may be improved, which will provide a greater volume of goods and services. So people will work harder knowing they get to keep more of their money. A less progressive tax system reduces the distortion of the price mechanism. Basically, relative wages are needed to provide the incentive for workers to allocate their resources. So the argument here is, in more simple language, is that a less progressive tax system will mean that more people are incentivized to become their best or to allocate their resources to the optimal use. So more people will be incentivized to become a doctor or other high income professions because they know they're not going to get taxed as much. If marginal tax rates are too high, the after-tax relative salaries to become a doctor may not warrant the extra education and training, and therefore we may have an ongoing shortage. Therefore, allocative efficiency is not realised because people aren't entering these professions. So basically what you're doing is you're making links to the effort to work hard, and therefore technical efficiency improves because you don't get taxed as much, you may work harder, and more incentive to develop your skills and to get an education. And then also the fact that you're not getting taxed as much is more of an incentive to shift resources or allocate resources to their best use. So more people will choose the professions that they're best suited to because they know they're not getting taxed too much on that income. Thank you.